So if you read the news and you watch any YouTube channel at the moment, you'll know that Evergrande is on the brink of collapsing the Chinese economy, and the S&P 500 just dipped 2% yesterday, wiping billions and billions of dollars off some of the world's largest companies. Analysts keep talking about the impending crash, and every major bank wants to tell you that this bull run that we're on, which is the longest we've ever known in history, is suddenly just going to go and end in a big 20% correction. With that being said, what a great time to invest in a stocks and shares ISA with Vanguard. Right? Good time? So I'm currently on a little bit of a journey at the moment to kind of smooth out my investment portfolio, which is a mix, probably like a lot of people's. I've got some individual shares, got some passive funds, got some managed funds, got some crypto, got some equity in some other businesses. And I want to kind of smooth it out to weigh a little bit more toward those low cost index funds, because of course they've proven themselves time and time again throughout history. We know that index funds are a time tested strategy and have beaten active fund managers and people like me who try and pick the occasional stock and put us all to shame over that long period of time. So I know from my own personal experience that I really want to make sure that the majority of my holdings is in a long-term, low-cost index fund. And while I'm still going to enjoy owning the odd stock and of course a bit of cryptocurrency on the side, I want the bulk of my holdings to be exactly that, nice and cheap, set and forget, worry about that over the next 20 years. For anyone not familiar or maybe beginners in this space, an index fund is really just something which tracks an index. So for example, in the UK, we might have an index fund which tracks the FTSE 100, the index of the largest 100 companies in the UK. So there's lots of indexes out there and index funds out there which you can put your money into, and it will buy you a slice of every single one of those companies according to the weight on that chart. Similarly, exactly in the US, if you've got the S&P 500, there's loads of tracker funds which track this entire market, and if you invest into an S&P 500 index fund, you're going to get exactly that. You're going to get small slices of those individual businesses without having to go out and buy 500 different shares, which would probably cost you a hell of a lot of money in fees and be an absolute pain in the backside to manage. Anyway, rather than trying to time the market and investing during a terrible red day while everyone's afraid, why not invest today? Well, that was my strategy anyway, and to be honest, I didn't time it like this, and I really don't care if the market is apparently at all-time highs right now, or if I suddenly got lucky on a dip. Over the long run, it's not really going to mean much, and I plan to dollar cost average into this portfolio as a separate portfolio to my main Hargreaves Lansdowne one. It's funny, when I first started investing, I literally had no idea about a stocks and shares ISA and just opened up a normal fund and share account. And before I knew it, of course, I realized that any income that comes from that or any capital gains ultimately in that account are going to be taxable events, until I figured out that we could put £20,000 a year, at least if we're based here in the UK, every adult gets that tax-free amount, and all of my gains are completely free. So of course, as soon as I found that out, I started shifting my investments to my stocks and shares ISA, or especially when I was dollar cost averaging into the market. And at the moment, because I'm transferring some of my investments from Hargreaves Lansdowne to Vanguard, it's because Vanguard have some of the lowest fees in the industry. They've got a super low account fee at 0.15% of account value. And then also their funds, some of their passive index funds, are super low cost as well. And of course, over my time horizons of 20 plus years of investing, those fees will add up, and I want them to be the lowest possible amount they can, because some of these active funds and other fund managers will end up taking a lot of money off your investments in the end. So let's talk some figures and let's talk some numbers. So I've just sold a chunk of money from my Hargreaves Lansdowne account, quite luckily really from last week, into the S&P 500. So I had a low cost index fund in my Hargreaves Lansdowne regular account. And of course, what I want to do is move that money over to my Vanguard account and then build out from that position in a stocks and shares ISA that I opened recently with Vanguard, so I can contribute to this one this tax year. And of course, I do still have a stocks and shares ISA with Hargreaves Lansdowne too, but I'll probably contribute more toward the Vanguard one because their fees are so low at the moment. And I'll still keep my other investments in Hargreaves Lansdowne for now. So in total, I've got 10,000 lovely pounds to invest today, 500 of which are already on the platform when I open the account. So I've got £500 currently sat in an S&P 500 fund, and that ticker symbol is VUSA. Really super low cost, super cheap index fund covering the S&P 500. Because of course, I'm not going to bet against America, and I do believe that those 500 companies are going to continue to dominate for a long time. So my plan today is to, of course, lump sum all the investment in, and I'm going to balance that between probably the VUSA fund and a bit of emerging markets to give me some global exposure. And of course, I'm going to weight that investment according to approximately the kind of global weighting currently, according to what they actually produced on the global equities market. But mostly, as I've mentioned, I think the S&P 500 will hold most of my money, as ultimately it actually accounts for over 60% of the global market. And really, the gains in the S&P 500 and the index as a whole, and the index has been a really great benchmark for any other funds trying to beat it. And I think even over the long term, and that's the key thing here, I'm not really interested in short-term gains. I don't care if there's a 20% correction next week. I don't care what the headlines are. I just want to get myself started on my stocks and shares ISA with Vanguard for the long term. I could absolutely go for something like a Vanguard All-World Fund, for example, the FTSE All-World UCITS ETF, which is VWRL. It's a fantastic fund, really popular. You can go ahead and Google that one. And I did mention in one of my most popular videos about the best Vanguard portfolio you can make, that rather than having multiple funds, this single fund could be one of the single best investments you make, especially if you're planning to go over the long term and want a well-rounded, diversified portfolio. So I think here's what we're going to do. We're going to go 85% into the S&P 500, and on the other hand, we're going to go about 15% into emerging markets, which is roughly there or thereabouts how the market's split at the moment. Yes, I will be slightly overweighted on the S&P 500, but in all honesty, there's nothing else which really excites me at the moment, and I don't want to bet against the US. And if we then also consider national markets like the FTSE 100, that market at the moment is just a little bit too boring. I did another video based on that recently too, and for me, bit shaky. Anyway, the reason I'm doing this is because as much as we want to look back at history and we look back at the past performance, we've got no idea what the future holds. So I do want some exposure in the emerging markets, in the developing markets. Even if China is apparently on the brink of collapse, I think there's going to be a lot of growth in, of course, countries like China, India, etc., and all those other emerging markets. And I'd really like to take advantage over that over the next 10, 20, 30 years. And of course, I'll rebalance that as we go. Anyway, let's get this done. Let's talking. Let's get onto the laptop and get investing. As you can see, we're on my Vanguard platform right now. I've just logged in. As you can see, my £500 investment that I put into the S&P 500 is actually down at the moment. It was up at one point, but honestly, I don't care. I literally do not care, which is great. If anything, I can buy shares at a discount right now. So look on the bright side. So what I'm going to do today, of course, is build it up to £10,000. So I'm going to put £9,500 in, which I'd sold from my Hargreaves Lansdowne account. And it's really nice and simple, very easy to do this. So I'm going to go to the Invest Now section. Going to choose next available price, so there's no fees or charges to make the investment. And I've already made the investment choice. They're in my basket already. So there's two funds I'm going to be talking about here and choosing. So of course, the top one there is the FTSE Emerging Markets ETF. That trades as VFEM. And of course, that might be available on lots of other platforms as well. So I'm almost certain it's on Free Trade and Trading 212 or whatever broker you want to use. That's an emerging markets fund, and of course it's heavily invested, and of course that's spread out in countries like China and India, etc., as emerging markets, and it's got lots of different companies in there. I think there's around 1,500 companies or so that it's invested in. And then of course the S&P 500 fund, which needs no introduction, a nice easy ticker symbol to remember, which is VUSA, super low charges, 0.06% fee on this one, passive index covering the S&P 500. Right, so let's make this up. So if my calculations are correct, I've already got 500 into the S&P 500. So therefore, I just need to put 8,000 there. I need to put 1,500 here. And then of course, in total, that would give me a remaining ISA allowance of 10,000, which is correct. And of course, taking into account the 500 already invested, that will give a 10,000 total. So exciting times, investing. How exciting. It actually shouldn't be exciting. It should be really boring, and you should just do it every month, okay? And you'll be a millionaire eventually. Nice and simple at this point, of course. Please do all your own research and read the investor information. I've already gone through everything. I'm happy with my investment, and I know that the ongoing charges, as you can see, the emerging markets fund is slightly more expensive than the tracker or the S&P 500. Of course, there's a lot more variables involved there of making that fund, but this is super low fees and super low cost in the long run. There's so many funds out there which charge you a hell of a lot more. So nice and simple. Debit card payment for me. I'm never going to tell you all my debit card details, obviously. That would be stupid. Okay, so we just finished putting all the card details in. If you do want my full digits and my security code, of course, just give me a call and I'll give you them. All right, okay, let's do this. So submit that payment, tick the box. Okay, so all approved, order been submitted, which is great. So then that will then, of course, just get placed an order, and it might take a day to come through, add to my account, and there we go. I've invested £10,000. Happy days. So why am I in such a good mood, and why do I not care about all of these downsides and all the news at the moment? Well, in all honesty, it comes back down to this long-term mentality. So I feel like I've kind of gone through the ups and downs as an investor, and I still do get shaky occasionally and look at those red days. No one likes seeing the red days, but Because my time horizons are so long and I genuinely don't need that money right now, and I almost want to forget it exists and just leave it in the market, it doesn't really have the same attachment to me. So I kind of take away any emotional attachment I have to that money, and that is now an invested pot of money which will grow over the next 10, 20 years. And of course, every month I'll probably add to it different chunks across my other investments. So regardless of market conditions, I'm just not bothered. And I know by dollar cost averaging or investing monthly that this is one of the best strategies you have to kind of tilt things in your favor and essentially almost guarantee that you'll make money, as the longer you have those investor horizons, the better. I'm just not interested in short-term swings as much as I love keeping up to date with the news, and I hope you can kind of get to a same sort of position for yourself as well when you're investing. Because of course with timing, we've got no idea. I could be investing here at one of the lows of the market over the next 20 years, or I could be investing in a high. Over the next 3 years, the market could plummet 50%. Honestly, I don't care. That money is never getting touched. The only time that money would ever get touched, it would have to be an absolute dire emergency, and I'd have to be able to go YOLO on holiday if an asteroid's coming to the Earth or something. Literally an asteroid would have to come to the Earth for me to sell that investment. Anyway, what I'll do, I'll revisit this portfolio now and then and keep giving you updates. Really, if anything, it's going to be really, really boring. But I think what's important, if you're a beginner investor, for example, and you haven't done it already, is just to show that investing isn't necessarily going to be an exciting sport, but really the excitement and the reward is a long-term game. And really, it's all about now how much you can invest, how much you can save, how much you can improve from your job, for example, if you can do any other side hustles, where can you get some more money to invest in the market without, of course, having a really, really boring life. But then, of course, it's all about that long-term game, and whatever your own goals, aspirations are, where you are in life. Remember, I'm not a financial advisor, I would never pretend to be, so please do all of your own research and seek out professional financial help if you do need it. Anyway, I hope the video has given you a little bit of hope and making sure that you should pay less attention to the news and really don't care about what people say about the stock market and investments. If your time horizons are long and you're a long-term investor, just keep doing what you're doing, stick to whatever your own plan is and whatever your own risk profile is, and touch wood, you should do pretty well, especially over the very long term. Anyway, I hope you found the video useful. If you do, drop me a big fat like, subscribe for more, and I'll see you all in the next one.